Yeah. Okay, partnership transactions. And Sam paid Jim 500K, right? And he got LLC units. And under 99.5, this says that Jim sold half his ground, Sam bought half his ground, and then both were contributed and you had to go through the procedures. What if Sam contributes the 500K and gets units? And Brad, the smart tax guy, said, that didn't result in a current tax problem, did it? Does everybody agree that the contribution did not result in a tax problem? That it was an issuance of units and that step of calculating gain or loss didn't matter because there was no gain or loss? And then we did our normal 704 B balance sheet, 704 C balance sheet, inherent gain. And that looks a lot like that description. And that's how Brad, the tax guy, said, why don't we just contribute cash? Is that all fair? Well, why don't we? 707 says you can't. 707 says, this is year 0. This is 2 years. After 2 years. There's a rule that says if you have a contribution of cash to an entity and within 2 years of that contribution, so did Sam contribute 500,000? So 500,000 was contributed and we're year 0. Okay? With it, what 707 says, if during this 2-year period there's a disproportionate distribution of cash to non-cash contributor, okay, or Jim, right? Jim contributed ground, correct? So disproportionate distribution of cash to the non-cash contributor, which is Jim, under a fact pattern. Everybody with me? Then the IRS presumes you were in situation 1. That really, even though there's a contribution of cash, there's a U-turn, and Jim got 500, that cash coming out is the exact same thing as Sam having bought the property from Jim. This is, for whatever it's worth, this is a rebuttable presumption. And what the hell does that mean? So let's say that Sam contributed the 500,000 to AB LLC. In cash, disproportionately comes out. The term rebuttable presumption means the IRS is going to assume that you're a bad actor. And the IRS is going to assume that you have a sale or exchange on that ground. But it's not a given. You have the opportunity to rebut or push back on that assumption. So the fact that you have this cash distribution within that first 2 years doesn't mean that you have a sale or exchange. So Jim is married and Sam comes in for 500,000. Jim's wife figures out Jim's not a good guy. Jim's got to go. So she divorces Jim. Jim needs liquidity to pay the divorce settlement. So he says, AB partnership, you got 500 grand sitting there. I'd like to get a $500,000 distribution that's disproportionate so I can pay part of the marital estate to resolve my divorce. Does it sound like Jim entered into this transaction with the intention of pulling that out as a sale or exchange? No. There was no part of the divorce that was part of this plan to get this money. Might have been, but we're going to push that aside. But some other factor in the universe that says, we didn't do this because we were trying to sell or exchange an item. We did this just because of our fact pattern. So, in year after 2 years, presumed not a sale. But guess what? That is also a rebuttable presumption. So, what happens on 2 years and a day? Jim's not getting divorced. Jim's life's good. And we get to 2 years and a day, and this 500,000 happens to do a U-turn. Because we just didn't want to do it in the first 2 years. The IRS can say, you guys strung us along, and now you still have a disguised sale. Leslie, what's this say?
Category 1, transactions with a partner other than in his capacity as a partner. Section 707A states that if a partner engages in a transaction with a partnership other than in his capacity as a member of such partnership, the transaction shall, except as otherwise provided in this section, be considered as occurring between the partnership and one who is not a partner.
Okay. A loan transaction, sale transaction, lease transaction. Okay, these are, if I can be a lender to the partnership, I can sell property to the partnership, and I can lease stuff to the partnership. That's what that's saying. Kelsey, what's this slide say?
Section 707A transactions include the following. Loan transactions. If a loan from a partner closely resembles an equity investment, it may be recharacterized as a capital contribution. A loan to a partner may be recharacterized as a distribution if appropriate to reflect the substance of the transaction. Sale or purchase of property between a partner and partnership, leases and incidental use of a partner's separate assets.
What's this one say?
Sales and exchanges between partnerships and controlling partners. Section 707B limits, in 2 respects, the scope of the general rule of 707A that sales and exchange of property between partners and partnerships are treated in the same manner as sales or exchanges between unrelated taxpayers. Section 707B1A precludes the recognition of any loss realized on a sale or exchange of property between a partnership and a person who owns more than 50% of the capital or profits interest in the partnership. Section 707B2A provides that any gain is ordinary income if property that is not a capital asset in the hands of the transferee is sold at a gain between a partnership and a person who owns more than 50% of the capital or profits interests in the partnership.
For those that are playing along and paying attention, 707B1A basically has a correlation to 267, Internal Revenue Code 267. And 267 is transactions between related parties. 707B2A has a correlation to Code Section 1239, which is sale of depreciable property between related parties. Now, why in the hell I have B1 and B2 in play when I have 267 and 1239 in play, I have no idea. I don't know what the substantial difference is because in my mind, 1239 is exactly the same as 707B2 and 267 is exactly the same as B1. So what the hell does all this mean? Which section are we specifically on, Alyssa?
707B1A.
Which correlates to which code section?
267.
267, which are losses between related parties. Okay. So what's our facts?
Okay, so A A owns land worth 100,000. A's basis in the land is 500,000. A sells the land to AB LLC for 100,000. So since A's loss is disallowed, does A get to take the loss in the future when AB LLC disposes of the land? No.
A sold the ground to AB Partnership for $100,000, correct?
Yes.
And the basis in the ground is 100,000 or 500,000, correct?
Yes.
If it were sold to an unrelated party, A would have a $400,000 loss.
Yes.
By virtue of A selling it to AB Partnership, which AB is related to,
Correct.
the loss of 400,000 is disallowed.
Yes.
So the question is, does A ever get to take advantage of that loss? Ever, 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 ever?
I would say no.
They do not. At least not as in the capacity as an individual. Now, as a partner, maybe. Okay, so what's question 2 say?
Since A did not get to take the loss and will never take the loss, is AB LLC's basis in the ground equal to A's basis? No. At the date of purchase, AB LLC's basis is equal to purchase price of 100,000 or 100,000.
We're 100,000. So AB bought that land for how much, Alyssa?
100,000.
So AB's basis in the ground at the date of purchase is how much?
100,000.
Okay, so what's the next question say? Because this is slightly mind bending. It's not hard, but this is slightly mind bending, or it was the first time I encountered it.
So did 400,000 of basis disappear never to be used? It depends.
It depends. Okay,